Ladies and gentlemen, welcome back to the channel. Today, not exactly a great day for Tesla, although we did have some big news that we talked about in the previous video posted at 4 p.m. today. Tomorrow is going to be another big day for markets as well. We'll go over the catalyst that will be coming out. And again, my thoughts around today's catalyst. Today, we had 911,000 jobs that were revised away from March of 2024 through March of 2025. That was a huge number. In fact, the largest one-year revision ever for that data series. And it's worth diving into a little bit more. We'll talk about the Fed and rate cuts and all of this in today's episode. Hit that like button as well as subscribe to the channel if you have not done so already. Check out that link down below in the description of this video. If you want to come trade with us, come get involved in the best trading community in the entire world, where we are going out finding small cap AI stocks before anyone else does. It's better to be early to something than wrong or late. So yeah, you just got to spot the opportunities early and you're going to make a fortune in markets. In fact, while it's not, the best return out there, the trading community portfolio is up 120% year to date. And again, as I've said for a while now, I think it's going to be up over 200% by the end of this year. Maybe even more than that. So yeah, it's gonna get exciting. Not financial advice, not a recommendation. Obviously, come to your own conclusions, make your own decisions when you're investing. You get the idea, but come join us if you would like to. Link down below in the description of today's video. Now, in the news today, JP Morgan CEO Jamie Dimon says the economy is, quote, weakening. JP Morgan Chase CEO Jamie Dimon said that the Labor Department's report released Tuesday confirmed that the U.S. economy is slowing down. The department revised lower its non-farm payrolls data for the year through March 2025 by 911,000 jobs from the initial estimates. Jamie Dimon says, quote, I think the economy is weakening, Dimon said. Whether it's on its way to recession or just weakening, I don't know. This is not the first time he said this. Okay, this is a pretty common thing for Dimon to say. He believes and has believed this entire time there's like a 40% chance of a recession. Okay, and he's not really wavering from that. He says, quote, there's a lot of different factors in the economy right now, Dimon said, citing the weakening consumer and still robust corporate profit. He says, quote, we just have to wait and see. The Federal Reserve will, quote, probably reduce its benchmark interest rate at an upcoming meeting, though that might not be consequential to the economy, Dimon said. Basically, Jamie Dimon is saying, hey, it might not, do anything to the economy. We're past that point. Maybe Fed rate cuts are not as important for helping the economy. Now, today, surprisingly, following the downward jobs numbers today, the odds of a 50 basis point cut for September 17th, which is next week, actually fell from 9.9% to 4.1%. You're still pricing in a 100% chance of a cut next week, and that doesn't seem likely to change even if CPI comes in a little bit hot later this week. We'll get into that in just a moment. But what all of this data will do, mostly, it'll move the odds for October and for December. So the odds for October 29th are 78 or 79.3% chance of another cut. So you're firmly pricing in a cut in September and October. If CPI comes in hot or we start to get some better economic data, the odds might fall, but you are pretty firmly pricing in another cut for October 29th. There's only a 17.3% chance of one cut between September and October's Fed meetings. So yeah, it's almost a certainty. December 10th, you're pricing in a third cut at 65.2%. The odds of 4 cuts at 2.7%, and the odds of only 2 cuts at 28.8%. So you're firmly expecting 3 rate cuts into year end. Now, here's the deal. Like Dimon said, like JP Morgan CEO said, if we're getting rate cuts for the wrong reason, like the economy's weakening or recession odds are going up, that's an issue. If we're getting rate cuts because the economy is doing okay, it's not doing great, but inflation maybe is coming down, that's a good rate cut. And in that scenario, stocks should do well. Okay. Now keep in mind, you're in a weak seasonal period. And again, as I said in the prior video, like, I'm surprised stocks did so well today. Tesla did so well today. All things considered, like, it was a bad number we got today. And stocks didn't sell off. That's impressive. Now, tomorrow we are going to get PPI month over month for August. Now, PPI normally is not super important, but with tariffs, it's a little bit more important. PPI is producer price index or producer price inflation. CPI, consumer price index or consumer price inflation. Okay, so PPI, a lot of people are going to read into that as a early warning sign for the CPI report. So Wednesday or tomorrow is not important as much just for PPI, but for the indications of what CPI could look like on Thursday. Now, we do have a 10-year bond auction as well tomorrow. The last 10-year bond auction we had was 4.255% coupon on that. And you can see as of today, 10-year treasury yields are at 4.68%. They're up about 2 basis points today. So, you know, that yield, if it comes in lower than where 10-year treasury yields are trading at right now, you could see another drop in yield. So that could be a kind of semi-important catalyst tomorrow as well. Thursday is the big day with core CPI month over month expected at 0.3%. Unchanged from last month, but as I've said before on this channel, it really depends where the decimal comes in. If the decimal comes in 0.25% and you get rounded up to 0.3%, that's a much different number than 0.34%, where on a 12-month annualized basis, that would be close to 4% or a little bit over 4% inflation. On the low side of 0.3%, again, 0.25 is about 3% annualized inflation. So there's a big difference between where the actual decimal point comes in and the implications for inflation. So it could be all about the decimal point on Thursday, but you do want to see a lower than expected number. And I think we should get that, right? If the economy is truly slowing down, we're not going to have an inflation problem. We're going to get, weak inflation numbers because inflation does not survive during a weak economy. That's something that maybe not a lot of Wall Street understands or will tell you publicly. Now, core year over year is expected at 3.1%, unchanged from last month. Headline inflation month over month is expected at 0.3%, higher than 0.2%. That was the number for last month. And headline inflation year over year is expected at 2.9%, higher than 2.7%. That's the number we had last year, or for last month on a year over year basis. We're expecting initial jobless claims as well to come in at about 235,000, which is a pretty good number. And then on Friday, you have Michigan consumer sentiment that will be coming out. 1 year and 5 year inflation expectations will be most important from a Wall Street perspective. But again, I'm encouraged with what we've seen today in markets that yes, the Russell was down. Yes, it wasn't super great across the board today in markets. Some areas did better than others. AI did pretty well today. Other areas did not. But you didn't see a panic. You didn't see a recession, fear-driven sell-off. And that, to me, is encouraging because keep in mind, retail does not move markets. Big money moves markets. And if big money was getting fearful here, you would see it clear as day in markets. And we are not seeing that as of now, which as long as we don't get some kind of large growth scare, the year-end rally is in play. Now, as I've talked about before on this channel, the U.S. economy doesn't just walk into a recession, right? It's too big. It's too diversified. Like in the last 50 years, we haven't walked into a recession. You need a catalyst. You need some kind of shock event. You need something bad to happen. China trade embargo was a catalyst. It didn't last long enough. I don't think we're seeing a recession because of that. I think partially the economic data that we're getting is delayed as well. So some of the weakness in data that we're getting is probably the 4-8 weeks after tariffs went into effect, where things did kind of slow down, where there was a fair bit of uncertainty. I think we're kind of getting away from that now. And over the next couple of months, the data is going to look a lot better, and you're not going to have this recession or growth scare into the end of the year, which will fuel an end of the year rally as seasonals get better as we go out of September or come out of September and go into October, November, December. That's when I'm expecting to see quite a large rally. Now, I want you guys to take a listen to what Goldman Sachs' David Kostin said on the year-end playbook for equities. Take a listen. It's only about 4 minutes long.
This morning, putting out its U.S. equity playbook for the rest of the year, forecasting some more gains ahead. Speaking of which, joining us here at Post 9 today, David Kostin, Goldman Sachs Chief U.S. Equity Strategist. David, it's great to see you. Welcome.
Nice to see you, Carl.
Your work lately, on Friday, you had a piece about the AI trade moving into what you called phase 3. Mm-hmm. You've had some pieces about fading tailwinds from buybacks. Mm-hmm. What does this report essentially tell us?
Well, we know that about 38% of mutual fund managers have outperformed year to date. And so that's a relatively modest level. And so we're looking at what are some strategies that portfolio managers should be employing for the next several months from now to the end of the year. And so there's sort of 3 observations. The first is alternative asset managers. So when we look at the financial sector, banks, et cetera, a lot of financials did, sold off a lot in the wake of the Liberation Day. And the alternative managers, Carl, have not really come back that much. And so we think there's a valuation opportunity. We think some of the developments in the capital markets, the kind of reopening of the IPO market would be beneficial for some of the alternative manager, some of their portfolio companies. We have the prospect of some of the 401k reforms that the Trump administration has put forward. And so those are some of the, if you will, macro developments or some of the industry-related developments that would help that sector. We look also at some of the gold mining stocks, the Goldman Sachs commodity strategist, looking for the gold is going to something in the vicinity of 4,000. So that's another lookout over the next 12 months, something like 17% gain from the current levels. So that would be a potential catalyst. You got more central bank demand for that product and some of the ETFs as well. So those are, and the third I would emphasize is the companies that are benefiting or might benefit from a cut in the Fed rates, because you look at companies with a high degree of variable rate debt. And so if the Fed cuts rates, they'll less interest expense. That leads to positive earnings revisions, and that is the argument. So those are sort of 3 investment strategies when we look at ways to outperform a market that's likely to go up maybe 2% from now to the end of the year, maybe 6% in the next 12 months. So there's a generally rising market, but that's the strategies we look at.
I mean, mutual fund, 38% is not bad for them, David. Come on. I mean, they don't. When was the last time they actually outperformed as a group? Never.
Well, 2022, when the Mag 7 really got
crushed.
That was, and since many of the portfolio managers in the mutual fund industry are underweight those stocks, that actually was a benefit. But
that's
you're right.
Good point.
In the last several years, it has been a challenging environment.
Well, it's been challenging for a long time. That said, you raised the Mag 7. Maybe Mag 8 now.
Right,
We now include Broadcom.
Okay.
Continued concern.
Maybe the Elite 8.
The Elite 8. I like
okay.
that. Yeah. Continued concern at all in terms of the overall weighting of 7 or 8 stocks in the S&P at this point, and the importance of them?
It has been a concern. The idea that 7 stocks, for example, are something in the vicinity of around a third of the S&P 500 market cap. So that definitely introduces a unique risk to the market. One of the big variables is around the amount of capital spending that's taking place. And yesterday at the Goldman Sachs Tech Conference in San Francisco, NVIDIA commentated about the idea of $3 trillion, with a trillion, capital spending that they anticipate over the next several years from now to 2030. So that would be a tailwind to the extent that would be maintained, all that capital spending. Now that is a source of some risk, because if it decelerates and trees don't go to the sky, so that would be a potential risk. But from a fundamental point of view, we looked at the results in the second quarter, David. They had really strong earnings. All those 7 companies up like 28%.
And they didn't change their CapEx plans at all.
And they did not. And so that would be the argument. But it's a concern because the concentration historically, that does not persist for forever. And the idea of you get a catch up, where lower multiple broadening of the market rises, or do you have a catch down? Some of those biggest stocks come down. I think the catalyst for the catch down potentially would be a deceleration in the amount of capex that you emphasize, and the broadening of the market would be more consistent with our view in terms of economic activity, more companies participating in an economic expansion that's continuing at a still below trend rate right now, but likely to go back towards trend in 2026.
I also want to add one more thing to this, okay? That as Wall Street gets bearish and they get negative and they have these negative views of the economy, that changes the pendulum, right? So again, to get upside in markets, you need surprises. You need a wall of worry to overcome, to surprise, okay, to the upside. As everyone's getting all bearish, stocks are holding in there. That's great. That's one component. Stocks are holding in. But Wall Street's getting incrementally more bearish on the economy as we do get surprise good data mixed with one of the best earnings seasons we've had in years, which was the prior earnings season we just came out of. It sets you up for an upside surprise, for a re-acceleration in the economy, right? Even though I think it's just lag data, it does set you up for upside into the end of this year, as partially what David there with Goldman Sachs was saying. And I think Tesla is a prime beneficiary of this. We've had a lot of good news recently that will start to get reflected more and more in the stock. Ladies and gentlemen, let me know your thoughts on this down below in the comment section. Hit the like button as well as subscribe to the channel. If you want to come trade and win with us, check out that link down below in the description of today's episode. Have a great rest of your day, and I will see you in the next one.